and welcome to the latest video of the Global Outlook from the Economist Intelligence Unit. My name is Agathe Demarais and I'm the Global Forecasting Director at the Economist Intelligence Unit. I'm joined today by Nico Fitzroy, our Risk Briefing Manager and Senior Analyst for the Middle East, and Alessandro Cugnasca, an analyst in your Europe team. Today, we're going to discuss the outlook for the Eurozone in 2021 and some risks to the global economy in 2021 too. Before we start, one word about our latest revisions to our global forecasts. We believe that global output, global GDP, contracted by 4.4% in 2020 because of the coronavirus-induced recession. We believe that there will be a rebound next year in 2021 of 4.5%. However, this forecast masks wide disparities across regions and countries. And actually, some countries are going to take much longer to recover, taking 4 or 5 years. Our global forecast is for global output to be back to 2019 GDP levels in 2022. But let's have a look at what this means for the Eurozone economy. So, Alessandro, I'm going to turn to you first. What's the outlook for the Eurozone in 2021? Which countries are going to fare better and which countries are going to fare worse?
So next year, the Eurozone will be one of the fastest growing regions in the world, and we forecast its economy to expand by 4.8%. To a large extent, this is a mechanical rebound from the 2 waves of lockdowns that we have seen first in spring and then in autumn of this year. We expect also to see a significant degree of heterogeneity between countries. So the best performers in 2021 will be countries with a large industrial base, such as Germany, for instance, where we'll see that the economy already began to strongly rebound after the first round of lockdowns in spring. This is largely to an extent due to the fact that manufacturing is much more resilient to social distancing measures than services. And we're already seeing now that in the fourth quarter, soft indicators are pointing to a new downturn in the service sector while manufacturing continues to expand. A second group of countries that will perform very well next year are those that are specialized in services that are relatively less affected by social distancing. For instance, countries like Ireland, which is a large IT sector, or Luxembourg, which is specialized in financial services, will do fairly well. At the other end of the spectrum, of course, we will see that once again, the worst performing countries will be those that are highly dependent on tourism and tourism-related services. So this particularly applies to the southern economies of Italy, Spain, Portugal, and Greece. It's important to note that in 2021, the pandemic will continue. We now have several successful vaccine candidates that are in the process of clearing the necessary regulatory approval. But that distribution will initially be limited to priority groups and other vulnerable people. So accounting for virus production delays and bottlenecks, we expect mass vaccination to start only from September onward. So in practice, this means that the Eurozone will continue to see social distancing measure during the first half of the year. And throughout this time, the economy will continue to be dependent on government support.
And actually, since you're talking about government support, we've seen that fiscal policy has been quite expansionary over the past few months, over the past year. What can we expect on this front, and how about monetary policy? Well, in summary, what can we expect for a policy mix?
Yes, the European Central Bank has now announced an additional 500 billion euros of asset purchases under its PEP program. This brings the total size of the asset purchase program to 1.85 trillion. Asset purchases are now expected to continue until March 2022, and the ECB also expanded its other stimulus measures, such as easier collateral requirements and improved financing conditions for banks. So monetary policy will continue to be highly accommodative next year, but borrowing costs are already at record low level, and there is not much room left for additional credit easing. So the main objective of the ECB right now is essentially to maintain financing conditions stable at their current level, and therefore making sure that the economy can safely move beyond the pandemic. As far as fiscal policy goes, this will remain highly expansionary also in 2021. The overall budget deficit of the Eurozone will improve from around 9% this year to around 6% this year, but this is largely the effect of the mechanical rebound of the economy. So it's a result of large windfalls, tax windfalls for the government. But budget deficits, in particular, will remain very large in countries like Spain, France, and Italy, where they will continue to exceed over 7% of GDP. Whereas in Germany, we expect a deficit of only 4% of GDP. And again, this divergence largely reflects the speed of the recovery. A problem that will persist in the Eurozone is that countries with the lowest recovery are also those with the highest debt burden. And in these countries, we will continue to see that limited fiscal space will prevent an adequate policy response.
Thanks so much. And maybe one final question. We're seeing that the EU is moving forward with the EU Recovering Fund, overcoming the vetoes of Poland and Hungary over the conditionality rule of law. I think that there was quite a lot of media attention around this over the past few weeks. What can we expect in terms of the impact of the fund on the Eurozone economy?
So the Recovery Fund is an important step forward for the Eurozone. Essentially, it's a temporary fiscal capacity at the EU level. The European Commission has now been authorized to raise 750 billion euros on financial markets and distribute these to the member states through in part loans and in part grants. This was decided in order to help precisely those member states that have the least fiscal space and make sure that the economic recovery is not too uneven across the Eurozone. The fund should lead to an additional fiscal expansion of around 5% of GDP over the next 5 to 7 years. And this will be largely used to finance new investment projects, which could have a positive long-term impact on growth. But again, this is a multi-year plan, so only a fraction of this money will be used in 2021. And therefore, this is a very important project. Most of its impact will be felt beyond 2021.
Thanks so much. And maybe one note to add, it's also a political project. I think that's something that many of our clients have been asking about, and that's a very important point. So I'm going to turn to Nico now to discuss the global risks to the economy. Well, obviously quite a lot to say. So the landscape in 2020 was quite difficult to navigate for many of our clients. Nico, what are your thoughts? How is the global risk environment likely to be in 2021?
Well, I think it's become clear now what the kind of direct economic impacts of the pandemic are in 2020, at least. We know that most economies have gone into recession. So now I guess the way to look at the 2021 landscape is to think about the impact of those, the kind of secondary impact. And one of the key ones to look at is going to be around social unrest and social stability. Even in 2019, before the pandemic hit, there was a big uptick in social unrest. Countries from as diverse as Chile, Hong Kong, Lebanon, all saw kind of big protest movements disrupting business. So I think when you factor on top of that, the kind of big hit to income levels in 2020, and also the restrictions that have come with lockdowns, the restrictions on people's freedoms, the likelihood is we'll see a big spike once kind of some restrictions start get lifted again in 2021. And when looking at the kind of countries and trying to pick out particular countries that we think will be most volatile and most affected, I think there's 4 indicators to look at. One is the kind of level of GDP contraction, so that how high the hit is to income. 2, how tough lockdowns are, so how great the restrictions have been on freedoms. The 3rd is kind of underlying tensions. So again, the countries where there were big spikes in unrest in 2019 would be most at risk again in 2021. And 4th, I think the most important one, is around fiscal space. So countries that went into the crisis with a weak fiscal position are going to be unable to provide the stimulus needed to kind of assuage concerns, and in some cases are going to have to undergo consolidation measures, which typically are what causes social unrest. Things like increasing revenue and also kind of cutting back on various government spending. And so when you factor in those kind of 4 elements, and particularly that 4th one, 2 regions stand out as looking most at risk of kind of large-scale volatility in 2021, and that's Middle East and North Africa and Latin America.
But maybe on a more positive note, we've seen a flurry of announcements regarding the approval of several vaccines in recent weeks. So our baseline forecast is that these vaccines will not be widely available before mid-2021 in rich countries. But Nico, do you think there's some upside risk here? Maybe it could be faster. What do you think?
So I mean, upside risk obviously centers almost completely around the ability to distribute and roll out a vaccine very quickly. But actually, there are some signs of recovery, beyond that. China, we've seen quite strong growth since the first quarter, and in the US, I know the stock market isn't always a good indicator of real GDP performance, but there is a kind of broader based growth in stocks beyond just tech stocks at the moment, which indicates a kind of improving investor sentiment. So when you kind of combine that with the potential for a vaccine to be rolled out effectively and quickly, say in the first quarter of 2021, there is the possibility of a much faster rebound given kind of pent-up demand. Obviously, logistically, that's going to be very difficult, and the idea of kind of distributing the vaccine more widely and more broadly across the world is also going to be very difficult. But there is the possibility that it could happen, and if that does happen in China, the US, and some other big economies, say in Europe, then the feed-through effects would be quite significant, because it would lead to a pickup in global demand and therefore trade. And particularly in the kind of poorer economies, even if they haven't seen the vaccine dispersed to them, if they're, say, commodity exporters, the benefits would be relatively significant. And so I think, you know, if those factors all combined, although still unlikely, there is the possibility of a kind of upside risk and a major recovery in 2021.
Okay, so let's finish on this positive note. Thanks so much, Alessandro and Nico. We're coming to the end of our video now. You can always find our latest analysis on www.eau.com. Keep an eye on our latest white papers. We have white papers on US-China relations, the impact of the pandemic on supply chains, and of course, our latest global economic outlooks. You can also find our research on Twitter at the EAU or on our personal Twitter feeds. Thanks very much for watching this video today, and I look forward to recording the next one next month. Thank you very much. Goodbye.